Hello everyone and welcome to the sessions on economics for finance. And friends, your classes of economics for finance getting started with the very first chapter in your study material, which is even the first chapter in my book, and that is titled as National Income. So let me tell you, chapter 1 in your book is classified into two units. The first unit is concept and determination of national income, and second unit is all about Keynesian theory of income determination. It is all about traditional theories but very important theories, and that makes chapter 1 very important as well as very interesting. So if you are looking into any business newspaper, any business magazine, if you are looking into any business news channel, you will be hearing a lot about national income, GDP, GNP, and then GDP is computed and reported at different bases, like GDP at market price, GDP at factor cost. Then there is something called GNP, gross national product, and gross national product can be again computed using the market price as the basis or the factor cost as the basis. Then comes yet another base of determining national income, that is NNP, that is net national product, or it could be even NDP, that is net domestic product. Now when we say domestic product, when we say national product, how do these terms differ from each other? We have to learn a lot and we have to learn everything in details, and there will be different bases of determining national income. So what I am going to tell you is, let us first understand the concept of national income. Concept of national income, let us first clarify, and then we go to the next stage, that is determination of national income. So talking about concept of national income, and most important thing, why are we trying to determine national income? What is the objective? See, if you are learning something and if you don't know why we are learning, and you just keep on reading without knowing the objective, believe me, you will land up nowhere. So whatever you are reading, whatever you are trying to learn, you should first be clear about why we are doing this, for what reason we are doing this. So when we are talking about concept and determination of national income, you should definitely understand, number one, what is this national income all about, and second thing that you need to understand, why do we have to determine national income. See, once your objective is clear, then the process of determining national income will also come on its way easily. So objective, why are we determining national income? So let me begin with some simple comparison. See, there will be, say, two individuals. One individual is earning, say, just 50,000 per month in terms of Indian rupee. Second individual is earning rupees 5 lakhs per month in terms of Indian rupee. 50,000 per month, 5 lakhs per month. So if you compare, you will see who is richer, who would be creating more wealth. When you compare, you come to know that, okay, individual A, individual B, both of them are reporting their individual incomes. So which one is earning more and which one will be having a big chance of creating wealth, and you can compare the income and identify. Likewise, at a little broader perspective, we may compare business organizations like company A compared with company B, company X compared with company Y. Then if you still go for a much macroscopic view, you are going on, zooming out from the map of the world, then you will find no individual in our nation, but you will definitely find picture of India over there. So then you compare India with other countries. So how much is the income of the country? If you are able to determine that, you will be able to compare the nation's income with the income of other nations and see, income wise, wealth wise, where do you stand, where others stand. This comparison could be definitely fruitful, because what happens, if you are observing other people progressing ahead, it could be a good thing to get motivated and inspired from other people's growth, and you also should then take steps to move forward. And it is all about the positive mindset when you are making a comparison. The moment you start making a comparison with anyone with a negative mindset, and you have a feeling of jealousy, that is never going to be fruitful. Comparisons are good when you are taking other people as benchmark and trying to improve your potential. So when you are students and when you write test in the class, or when you write some exams, you end up comparing your marks with your friends, right? That time again, your comparison, suppose you scored 80 out of 100 but your friend has scored 86 out of 100, you would say, wow, that you have scored much better than me. What did you do to get this score? Let me also know so that I can also improve my score. That should be someone's tendency. So the idea is, if you can identify and assess a country's overall income, you will be able to compare the country's income with other countries. So national income determination becomes a highly important matter. When we are talking about the global economy today, India has been highlighted as an upcoming nation, which is coming to be one of the great powerful nations across the world. On what grounds do we assess that India is growing like this? Of course, we are comparing the national income. National income of our country compared with the earlier year's national income, and national income of our country compared with the other nations. So you are comparing horizontally with other nations, and you are comparing backward with how you have grown in terms of your national income. So what exactly is national income and how to determine that becomes very, very important matter. Now I'll give you one very, very important perspective, and what I'm trying to tell you now, I would want you people to visualize this. This visualization is so important that you will be able to get the exact pulse of this chapter if you are able to visualize with exactly what I am telling you. This visualization is important, and I want you to just pay attention on what I am saying. Imagine that there is one company, X Limited. I am talking about a company. That company, say, produces this one product. This company produces one product, and there is a customer who is going to buy this product. And you know that there are factors of production. We have seen in earlier lessons in economics what you have learned at foundation level, and even at your senior secondary or your junior college level, where you have learned there are 4 factors of production: land, labor, capital and enterprise. I am sure you are aware of that. Am I right? Land, labor, capital and enterprise. So the person who provides land should be given rent as a reward. The labor should be rewarded with wages. The capital provider should be rewarded with interest, and the enterprise should be getting the remainder balance in the form of profit. So there are 4 factors of production, and each factor should be rewarded. So obviously, whenever I am manufacturing this product, you can imagine that there must be 4 factors of production involved, and each of them will be getting their income or their rewards in the form of income for making this product. So now understand, assume the worth of this product is rupees 1000. So the company produced this product and it has got the value of this product as rupees 1000. Person who purchased this product, that person would pay 1000 rupees to the company and will buy this product. And now when company receives this 1000 rupees, out of that 1000 rupees, it will pay rent to the land, it will pay wages to the labor, it will pay interest to the capital provider, it will pay profit to itself in the form of the residuary interest left over, that is profit, which will be earned as a residuary income by the enterprise itself. So out of 1000 rupees only you are going to divide that, right? Because 1000 rupee was the revenue collected by the company, and that 1000 rupee will be contributing to all these 4 types of factor rewards, or you can call it as factor income, that is rent to the land provider, wages to the labor, interest to the capital provider, and profit for the enterprise. All summed up will be obviously totaling to 1000. Now if you go and ask the land provider that, boss, how much rent did you earn? Then go and ask the labor, how much wages did you earn? Go and ask the capital provider that how much interest income did you earn, and ask the enterprise how much profit did you earn. When you are asking this question about income earned by this factor, each of these factors, and you sum up their income, the amount will be rupees 1000. In my example, the amount will be rupees 1000. Now you look into the customer who bought this product, right? The customer who bought this product, that customer has spent from his pocket rupees 1000, because 1000 was the price of this product. That customer has spent rupees 1000 from his pocket for purchasing this product. That person did not earn income, but that person has made an expenditure. And now if you talk about what was the value created by the company which manufactured this product, what we call as value addition. So from the scratch the product was made, so the product's worth is rupees 1000, so the value added will be considered as 1000. Now look at one thing. We have 3 different dimensions of measuring income. One is by expenditure method. So ask that customer who bought that product that how much did you spend? The report is 1000. You go and ask the company that has manufactured this product that what is the value created by you? They will report the value added or the value created is rupees 1000. Now go and ask those factors of production, land, labor, capital, enterprise, that how much did you earn in the form of factor income? The sum total of all those income will also be rupees 1000. So we have 3 different methods of determining national income. 3 different methods of determining national income. The first method is what we call as value added method. Second method is what we call as income method, where we are assessing the income earned by these factors, and third method will be the expenditure method. So value added method, income method, and expenditure method. So we will have 3 different methods of income determination. So before I take you to the details of how to determine national income, let me tell you the small example that I have just explained. If you make this as a much broader example, instead of that company manufacturing this kind of product, talk about a nation that is making huge series of products and providing lots of services. So those products and services produced by a nation will be the gross domestic product, and you sum up the value of all the products and services rendered and produced, you will be able to sum up the gross value added. That is what we call as gross domestic product, and that is the base for assessing national income. So that is a value added approach. You go and ask each individual, who could be a land provider, who could be labor, who could be capital provider, who could be an enterprise, that how much did you earn, and sum up the income of each individual. That will also give you a sum total overall income of the nation, and that is what we call as income approach for determining the national income. Or you can go and ask each individual consumer that how much did you spend for your livelihood, how much did you spend for this, how much did you spend for that, and take an aggregate of all the expenditures. Then also you will get the same value, and that is what we conclude that there will be 3 different methods of income determination. So now, as I told you, before I take you to the determination of national income, we need to now at least define what is national income. We need to understand the concept of national income, and then we step into the determination of national income. Now friends, throughout this chapter I will be giving you some important notes which you must write down, and writing these notes will be very important. So let me now take you to the notes writing segment, and please, without making any further delay, let us write. The main heading of the chapter is national income, within which you have written a subheading as concept of national income, and under this heading concept of national income, I want you to write the meaning of national income. So here we go with the meaning of national income. The net value of all economic goods and services produced within the domestic territory of a country in an accounting year plus the net factor income from abroad. National income is the sum total of factor incomes generated by the normal residents of a country in the form of wages, rent, interest and profit in an accounting year. I want you to first write this and then I'll explain this definition in details. So please do the writing work quickly. I'm waiting for you. Alright friends, I'm sure you have finished writing this definition, and as I told you, I will be explaining you this meaning of national income in detail. When we are talking about the definition of national income, it is important to pay attention on each and every word. So I want you all to do one thing now. You have already written this definition. Now what you do is you focus on each and every word and try to understand what exactly it is trying to convey. So first of all, the definition begins with the words the net value. So there will be a gross value that you will compute, and then there will be a net value. So national income is first of all not the gross value but the net value. So what is that difference between gross and net? I am going to talk about that in a while, but you should understand that the national income term is basically the net value of all. Net value of what? Net value of all economic goods and services produced within the domestic territory. So you understand one thing, within the domestic territory of our country, whatever goods and services are being produced, the net value of all that, when you sum up, it will be the national income. But do you notice one thing? They say that within the domestic territory of a country in an accounting year plus the net factor income from abroad. So to this domestic products and services what you have produced during the year, you have to add the net factor income from abroad. What is this net factor income from abroad? You would observe that lots of Indians, they have got qualified and they have got settled outside India. Some people are working in United States, some are working in Europe, some are working in Gulf countries, some are working in Australia, New Zealand, Canada. So worldwide, Indian laborers are spread and they are earning their income, and they are earning their income not within the domestic territory of the country, but they are earning income from abroad. So what will happen ultimately, these are by origin the Indian nationals. If they are earning income, somewhere they will be remitting that money to India, to their families, right? And as a result, what happens, even that will be considered as the income of our country. It is like, suppose there is a family where there are 3 brothers. The eldest brother, suppose the eldest brother has gone to Canada and earning over there in Canadian dollars and remitting that money to the family in India. So when you talk about the income of the family, it will be income earned by the second and third brother who are working in India, plus the income earned by the eldest brother who is working in Canada. So that will be the overall income of the family. Now let us expand the meaning of this family to entire country. So all the factors who are earning their income abroad, their income will also be part of our national income. So domestic territory, whatever goods and services you are producing, the net value of that, plus the net factor income abroad. Now why we are using the net factor income? Don't forget that the way lots of Indians are working abroad, there will be lots of people who are working in India, but they are not Indian nationals. They have been coming from other countries and working in India. In that case, they are producing products and services in India, but that income is not the income of India, but that income will be the income of that other nation from where these factors have traveled and are working in India currently. As a result, suppose an Indian citizen has earned 1000 rupees of income from abroad and a foreign citizen has earned rupees 300 from India, then the net factor income from abroad will be 1000 minus 300, that will be net 700. That net 700 is added to the net value of all the goods and services produced within the domestic territory. So as I told you, you have to keep a lot of patience while learning these concepts, and when you focus on the second paragraph in this definition, it is giving a different viewpoint, because now it is talking about the income approach. The first paragraph was talking about the value added approach, that you sum up the value of all goods and services produced. And the second paragraph in this definition is talking about the income earned by various factors. So basically, the definition itself conveys 2 different approaches of determining national income, that is the value added approach and the income approach. So once you have written this definition, let me take you ahead and let us write up some more notes. And when you move ahead and write some more notes, first you write the heading as determination of national income. So please write this heading, determination of national income, and then I take you ahead. Alright, when you have written this heading, determination of national income, let us move ahead, and under this heading you write the first parameter of measuring national income as GDP, gross domestic product. And within this heading, I will ask you to write a few components of GDP. So GDP with subscript as MP, when you write a term like this, GDP with a subscript as MP, how do you interpret this? It is gross domestic product at market price. So let me give the full form of this abbreviation. It is gross domestic product at market price. And how do you determine that? It is value of output in the domestic territory minus value of intermediate goods and services. I'm going to explain you this line very well and in details, but let us first do the writing work. So GDP at market price is basically the aggregate or the summation of value added. So please write up these few lines, and then I'll explain these components in detail. Alright friends, I'm sure you have completed writing this much. Let us now talk about this line, because when we say value added, the term value added itself means value of output in domestic territory minus value of intermediate goods and services. It is important for us to clarify the meaning of that line. So value of output minus the value of intermediate goods and services. Let us take an example that a farmer has produced in his farm wheat. That wheat was converted into wheat flour, and that wheat flour was used for making bread. So if you ask the farmer, what is the value of your output? He says some amount, say X. Then if you ask the flour mill owner that what is the value of your output, he says Y. And if you then ask the bakery that is making bread that what is the value of your output, they report as Z. Now what problem can happen if you take value of X as one output, value of Y as another output, value of Z as another output, and you take X plus Y plus Z as the aggregate value of all the output produced, there will be double counting, because the value of bread definitely includes the value of wheat flour that was consumed for making the bread. So when we are counting, we should just count the value added. So suppose the value of the bread produced is rupees 20 and the value of wheat flour that was used for making the bread was rupees 8. So the bakery that has manufactured the bread has converted a value of rupees 8 into a value of rupees 20. So the value added by them was rupees 12. So you just count the value added by each enterprise and don't take the gross value, add the value added. So take the summation of value added. That is the concept of value added. So basically, to arrive at what is the amount of value added, what you should do is take the value of the entire output produced by all the enterprise and then subtract the value of intermediate goods and services consumed for making that output. So if you are making an output of X and for that you have consumed the raw material as Y, so the value addition made by you was X minus Y. So you will just keep counting the value added, because Y was reported by output of another entity. If you are reporting X as your output and if we take aggregate of X and Y, it will be double counting. So we have to consider if Y is the output made by one entity, another entity has added value and made it as X, the value added by that other entity is not X, it is basically X minus Y. So I repeat, to arrive at value added, what you must do is you take the gross value of the output produced by you minus the value of intermediate goods and services consumed for making that output. So let me now take you ahead with some additional notes writing, and over here after writing this much you will be writing something more about gross domestic product at market price, and I would want you to write each line, but let us also parallelly understand each line. So this time let me explain each line first and then you will be writing. It says it is a measure of market value of all final economic goods and services, gross of depreciation. Now see what happens when one side you are talking about the product that you are making. So if I am making a product, I am using some kind of plant and machinery also for making that product, and that plant and machinery is going to depreciate, correct? That plant and machinery is going to depreciate. So one side I am creating value, but other side the value of the capital goods that I am using is depreciating, means the value is falling down. So logically the value that you have created on a net basis, net value, is the value of your output minus the depreciation. So when we talk about gross domestic product, it is just the value added without subtracting depreciation, that is before charging depreciation. And when you talk about the net value, it is after charging depreciation. So throughout the chapter, when I use the term gross, it would mean before depreciation. If I use the term net, it is after charging depreciation. So let me take you ahead with the next pointer. I'll give you time to write it down, don't worry. First keep understanding this. Produced within the domestic territory of a country during a given time period. Generally this time period that we are considering is basically 1 year. So it is sum total of value added by all producing units in the domestic territory. Includes the value added by current production by foreign residents or foreign owned firms. So it includes the value added by current production by foreign residents or foreign owned firms. So basically here we are talking about those firms which are not originally Indian firms. For example, some MNC has opened their branch in India. Now they are also producing some product in India within the domestic territory of India. Then the term gross domestic product at market price will include the product produced by them also. But the moment we talk about gross national product, which will be the next term, we are going to exclude that, because that income is not pertaining to India. That income is earned by foreign companies and foreign residents, and that is the time when Indian companies and Indian residents who have earned income abroad, their income will be added over here. So we have two different terms, gross domestic product and gross national product. When you are talking about gross domestic product, you are focusing of all the goods and services which are produced within the domestic territory of India. Now whether that production is obtained by Indian citizens or foreign citizens, by Indian companies or foreign companies, you are going to consider all that production. You are going to consider all production which is made within the domestic territory of India. So I want you people to carefully take note of this entire content, and then I take you ahead. Alright friends, I am sure you have completed writing this whole content. Now there is one more thing that I would want to talk about. Do you notice this word economic given over here, economic? So what is the relevance of economic goods and services? Because we are talking about production of economic goods and services. What is the meaning of economic goods or services? See, something produced may not necessarily be economic good. For example, you people may be knowing that I have one hobby of recording my songs, correct? In my own voice, I keep recording songs, and I do that recording within my same studio from where I am recording these lectures. Now when I record lectures, it is production of something. When I record a song, even that is production of something, right? But that recording of that song is basically my hobby. I am pursuing my hobby. It is not an economic activity for me because I do not generate income from that. So if you observe throughout the day, as an individual, you will be performing a lot of activities, and those activities will even include some non-economic activities. So your non-economic activities will lead to production of goods or services which are non-economic by nature. That should not be considered for determining national income. That is the relevance of the word economic goods and services. So I'm sure you are clear with that. And now with that, let me take you ahead to the next set of important notes over here. So you may write the title as important points, and we are still talking about GDP at market price. It includes the value of only final goods and services or only the value added by the production process. Intermediate goods refer to those goods which are used either for resale or for further production in the same year. They do not end up in final consumption and are not capital goods either. They have derived demand. I have explained you what is the meaning of intermediate goods. Then, used up in the same year, if they remain for more than 1 year, then they are treated as final goods. Intermediate consumption excludes fixed assets whose consumption is recorded as consumption of fixed capital, and GDP includes internal consumption. I am going to explain each of these pointers to you in detail, but let us first write it down quickly. Alright friends, I am sure you have completed writing these important points of these notes. Now, if you focus on this paragraph which talks about intermediate goods, let me explain you exactly what we are talking about and what all these points you have been given for intermediate goods, lot of points that they have derived demand, then if they are remaining for more than 1 year, then they are treated as final goods. Then you have to be little particular about when you are dealing with intermediate goods. So let me explain these points to you by giving some real life examples. So because what happens when you take real life examples, you actually end up understanding things better. Now this is generally a textbook that I provide to my final CA students, and this is the financial reporting textbook. This is the product produced by my company. Do you think if someone is ordering this textbook, I'll be sending this textbook just like this, or will I pack? Tell me. How do I send this book? Of course, I'll be packing this book. Now, for that, do you agree I will require a packing material? Now, this is a plastic bag in which we are providing this kind of books. So this plastic bag will be the outer cover, where there will be inner packaging as well, so that the book doesn't get destroyed. We use this plastic bag generally in the monsoons. Why? Because due to rain, I will not be using the paper bag. The other choice that we have is paper bag. Now paper bag, this paper bag costs me rupees 10 for each packing material. Each unit of packing material cost me rupees 10. Plastic bag cost me just rupees 6. Now I myself, I am an environmental friendly person. I will use plastic bags only during monsoons. But the moment monsoons are over, I will stop using the plastic bags and I'll start using the paper bags or the box packing, where plastic is not to be used, in spite of the fact that plastic will be much economical mode of packing for me. That is why focus on this line, that they have derived demand. See, not everyone would be thinking like me. Like, may not be that every producer is environment friendly, and they might have a policy of using plastic bags throughout the year. In that case, if they are using plastic bags throughout the year, then it's a different story. Then the demand that they will raise for the packing material will be plastic bags. I have demand for plastic bags as well as the paper bags. Now just if I change my policy that, oh, this plastic bag is actually little economical, let me also switch to plastic bags only throughout the year, then what will happen? The demand, see, my students will be placing order for the books. They are not concerned whether the books are coming in plastic packing or paper packing. They should just want the book condition to be proper, and they are interested in the book. They are not interested in the packing style. So recently I announced that there will be financial management and economics for finance textbook that we are providing, and we have a revisionary book for intermediate students, that is a revamp for intermediate students, and that is again for financial management and economics. So if you are placing the order for the bulk set of books or a single individual book which is for revision, either way we will be supplying these books in a proper packing. So when you place order, you will get it in a proper packed condition. This packing material changes with our policy. As a result, we have derived a demand for this packing material. So now if I again talk about this packing material, when we purchase, understand that for us this is an intermediate goods. So the value of the books that I have made for students, the value of the book is suppose rupees 1000, and the value of this packing material which is included along with that parcel, that is rupees 10. So basically the value that I have created is rupees 1000, but the value of intermediate goods that I have consumed is rupees 10. So the value that I have added is 1000 minus 10, that is only 990. So we are going with the point of value added only. So the gross value of the product produced minus the value of intermediate goods and services consumed. So suppose I have purchased packing material and I have stocks of packing material. Then by end of the year, I have to report what is the total value of output that I have created. So I will report that I have purchased 1000 paper bags, but I have utilized 700 paper bags. 300 paper bags are lying unused. Now earlier I was not counting that as my part of the intermediate consumption because I have used only 700 bags, not 1000 bags. If I have used only 700 bags, my intermediate consumption should be counted as 700 only. Then I have to separately report as a part of an output, because though it was not produced by my company, but it was produced by someone else, because it was not used as an intermediate product, it will be counted as a final product. So intermediate product should be considered as intermediate product only and only if it is consumed within the year. If it is having stock and it is being carried forward to the next year, then it will be treated as if it is a final good. Last point over here, that GDP includes internal consumption. For example, if I am a bakery making breads and I have made 50 packets of bread today, and one packet I took for my own consumption, I have sold only 49 packets. So the value added by me should be based on not 49 packets which I have sold, it should be including the one that I have made for my own consumption also. So internal consumption should also be included when we are talking about computing GDP. So that will be the discussion that I wanted over here. So time for us to move ahead and write something more. Economic activities include all human activities which create goods and services that are exchanged in a market and valued at a market price. And non-economic activities are those which produce goods and services, but since they are not exchanged in a market transaction, they do not command any market value. I have already explained you difference between economic activities and non-economic activities by giving examples. You just need to write down these pointers quickly. Alright friends, once you have completed writing this note about economic and non-economic activities, let us move ahead and now talk about national income, which is a flow measure of output per time period. The market value of the exchange of goods which already exist or are previously produced are excluded from the calculation of national income. So keep in mind, what you have produced during the current period, only that is included in national income. This includes the value of services that accompany the sale and purchase. For example, if there is a broker which is involved in selling goods or services which were produced earlier, so goods and services which were produced earlier are not part of the current year's production, but the broker who has given services accompanying the sale and purchase, the brokerage earned by that broker will be part of the national income. Types of goods used in the production process could be into two types: capital goods and inventory investment. So please write up these notes and then I take you ahead. Alright friends, once you have completed writing these notes, let us move ahead and continue writing further. So write couple of notes over here as well, and these points I have already explained to you. Just write it. Output of goods and services should be the output at market price in domestic territory only by residents or foreigners. Second point, it is calculated for a particular time period, so only current period output is included as gross output, and because we are computing this as a gross value, we must consider it as before charging depreciation. So please write up these a couple of pointers and then I take you ahead. Alright friends, once you have completed writing these pointers, let us move ahead and now write the main heading as determination of national income by value added method. So let me remind you, we have learnt one thing at the early part, that national income can be determined by three different approaches. That is the value added approach, the income approach and the expenditure approach. So approach is different, and if you have all the information on the table available, then income computed by any of the three methods will give you the same value. But what happens when you are collecting information not from an individual but from a country, and you are summing up income of all individuals, or you are talking about expenditure of each and every individual and government enterprises, do you think that you will be able to gather all the data which will reconcile with each other? The answer is no. It is next to impossible. So if I have all the information accurately available, then income computed by any of the three methods will be same. Which are those three methods? First one is this value added method. Second one is the income method or income approach. Third one is the expenditure approach. So as far as value added method is concerned, we have already started with value added method, because GDP at market price, it is computed by following this value added approach. So I first insist you to write this heading, and the moment we step into this heading, that is determination of national income by value added method, the immediate next slide that I will show up over here, you will get to know that this is something that you have already written. So gross domestic product at market price is in short called GDP MP, and how it is measured, how it is determined, you take the gross value of all the output produced during the year and subtract the value of intermediate goods and services. That is what we have learned, and this basically is summation of value added. So this slide what I have displayed over here, you have already written in your notes earlier, but what I am taking forward and what I am giving you now is to be written. I am sure you have written that heading, that determination of national income by value added method. So you may just give reference to GDP at market price, where you have already written your notes earlier. Let me take you ahead to the next point, that is gross national product. Now this is something different from gross domestic product. Here we are not talking about domestic product, here we are talking about national product, but still staying with the word gross. So GNP stands for gross national product at market price, and how it is determined, you take GDP at market price plus net FIA. Now what is this net FIA? You may call it net FIA or net FIFA, but what exactly is this? Net FIA stands for net factor income from abroad. So two factors you have to consider: income of Indian citizens and companies earned abroad should be added, and income of foreign country citizens and foreign country companies, or you can simply call it income of foreign citizens and companies that is earned in India, should be subtracted. So that is why we are using the word net. So net foreign income from abroad, it is defined over here as very clearly that it is income of Indian citizens and companies earned abroad minus the income of foreign citizens and companies that is earned in India. I want you people to write this part of the note, and then I take you ahead. Alright friends, once you have completed writing these notes, let us move ahead and write some notes further. So write a couple of paragraphs of some separate notes over here. GNP includes earnings of Indian corporations overseas and Indian residents working overseas, but GDP does not include these. GDP includes earnings from current production in India that accrue to foreign residents or foreign owned firms. GNP excludes those items. So here we are trying to differentiate between GNP and GDP. So please write up these pointers as well, and then I take you ahead. Alright friends, once you have completed writing these notes, let us move ahead and now start taking up the questions from your book. Question number 1. Let us read this question. It says, consider the following information with respect to Indian economy in the past. All figures they have given in rupees crores. Value of output in domestic territory. Value of intermediate goods and services. Income of Indian citizens and companies earned abroad. Income of foreign citizens and companies earned in India. Determine the following: gross domestic product at market price, net factor income from abroad, and gross national product at market price. Obviously, the only method that we have learned by far is the value added method, and that is what we are going to apply over here. So in order to solve this question, how would you proceed? Very simple. In your solution also you will be mentioning that all figures are in rupees crores. Value of output in domestic territory is rupees 25,000 crores minus the value of intermediate goods and services consumed, that will be rupees 10,000 crores. So value added, that is basically GDP, gross domestic product at market price, is mentioned as A, that is 15,000 crores. Now income of Indian citizens and companies earned abroad, it is 2,000 crores, and income of foreign citizens and companies earned in India is 1,000 crores. Net of this will be net FIFA, that is net factor income from abroad, that is marked as B, that is 1,000 crores, 2,000 minus 1,000. So when we talk about gross national product at market price, it will be A plus B, that will be GDP at market price plus net factor income from abroad, and 15,000 plus 1,000, in total gross national product at market price will be 16,000 crores. So please write up this whole thing, and that will be end of the solution. Alright friends, once you have completed writing this whole thing as the solution to question 1, let us move ahead and now write up something about net domestic product and net national product. So first of all, the major difference between the term gross and net is all about depreciation. So NDP MP stands for net domestic product at market price. The question is, how do we determine this? Very simple. From GDP at market price, you subtract depreciation and you will be getting NDP at market price. Now what is NNP at market price? It is net national product at market price. And how do you determine NNP at market price? It is gross national product at market price minus depreciation. Alternatively, what you can do is you can take GDP at market price plus net FIFA minus depreciation will also give you the same result. So try understanding one thing very clearly. We are trying to land up at 4 figures: GDP at market price, NDP at market price, then GNP at market price and NNP at market price. 4 factors. So what are these 4 factors? GDP at market price is basically the gross value added. NDP at market price will be gross domestic product at market price minus depreciation. Then to GDP at market price, when you add net factor income from abroad, what you will get is GNP at market price, and from that when you subtract depreciation, you will be getting NNP at market price. So 4 factors that you have learned by far: GDP at market price, then GNP at market price, then NDP at market price and NNP at market price. The definitions of each components are placed over here. So please carefully note down each and every point and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and write further. Gross domestic product at factor cost. Now here we are taking a different base of computation. Earlier it was market price, now it is factor cost. Let me explain this point to you. See, assume that the value of this product, the market value of this product is rupees 1000. This product market value is rupees 1000. When you are buying any product, you are an end consumer. When you are buying this product and you are buying this product for rupees 1000, you know, it is inclusive of all taxes. So basically in India, GST is the major component of indirect taxes. Every product and service you buy, it is to be bought along with the component of GST. So suppose you are paying fees for your classes, you will be paying some amount plus GST. When you are buying some product, it is the price of that product plus GST. Or sometimes the price of the product is mentioned as inclusive of all taxes. For example, if you are buying even medicines, it is mentioned that inclusive of all taxes. All products and services, except a few exceptions, they are all subject to GST in our country. Now what happens? If the value of this product is 1000 and suppose the component of GST included in that 1000 is rupees 200. So what will happen? It is not 4 factors among which the 1000 rupee value will be divided. If you can recall, earlier I told you that if this is of the value 1000, this 1000 will be collected by the company selling this product, and the money will be divided by 4 factors of production. Land will get its rent, labor will get its wages, capital provider will get interest, and the enterprise will be earning the residuary profit. But now we are including one more important component, that if this product was sold for 1000 all inclusive, that means GST component is included in its value. That money will be taken by Government of India. That money won't come into any factor's pocket as a factor income. As a result, when we are talking about gross domestic product at factor cost, for the company manufacturing this, it will have to eliminate the indirect tax from the gross value of the produced product. In other words, what you can say that the gross value added, which is GDP at market price, from that if you eliminate indirect tax, you will be getting the GDP at factor cost. So from the market price you eliminate indirect tax, you get the same GDP but now at a different base, which is GDP at factor cost. Now try understanding one thing. What will government do by collecting these indirect taxes? One side government is taxing the entities and collecting indirect taxes, and the income collected by government, what government will do with that income? Obviously they will spend it back to the public. They will make infrastructure, they will provide lots of benefits to the nation's citizens and various benefits, and some benefit is also given in the form of subsidy. For example, if you are establishing an industrial undertaking in some rural area, you get subsidies in the price of land, you get subsidy in the price of machinery. So government will tell you that okay fine, you want to establish industrial undertaking in a rural area, fine, you can place an order for maybe an imported machinery that you want to buy. The machinery value is say 40 lakhs. Government says that we will provide you subsidy of 25%. So we will pay 10 lakhs for that. That means government one side is collecting indirect taxes from the entities and using that money to provide subsidies to the same entities. So entities which are the producing units, they pay indirect taxes, but they get the benefit in the form of subsidies. Of course, not every company will be getting subsidy, only who are fitting in that eligibility criteria of government, they will be getting that subsidy. But from a broader perspective, if you see, you will find that in India, one side government is collecting taxes in the form of indirect taxes like GST, and it is utilizing that money to provide subsidies to these production units. So if you are considering all business units as one segment and government as another segment, from whom government is collecting indirect tax? From the business sector. And to whom it is providing subsidy? Again to the same business sector. So where you are taking GDP at market price minus indirect taxes to arrive at GDP at factor cost, by the logic you are subtracting indirect taxes, by the same logic you should add up if there is any subsidy given by government to these business sector. As a result, when we talk about GDP at factor cost, how do we measure GDP at factor cost? It will be GDP at market price minus indirect taxes plus subsidies. Alternatively, what you can do is, one side you identify how much is the indirect taxes collected by government and how much is subsidy given by government, indirect taxes minus subsidy, you arrive at a net amount called net indirect taxes, and from the GDP at market price you subtract net indirect taxes to arrive at GDP at factor cost. Once you get GDP at factor cost, then if I ask you to find NDP at factor cost, what you will do? Subtract depreciation from GDP at factor cost to get NDP. Gross and net, the only difference is depreciation. Then if I ask you to find GNP at factor cost, so you first arrive at GDP at factor cost, and then what you do? You add net factor income from abroad and you get GNP at factor cost. Once you get GNP at factor cost, I ask you to find NNP at factor cost, net national product at factor cost. From gross to net, again what you do is subtract depreciation, you land up at NNP at factor cost. So now we have 4 plus 4, in total 8 terms used over here. Let me remind you the flow of these 8 terms. First one what you learned was GDP at market price. Then second one GNP at market price. Third one NDP at market price. Fourth one NNP at market price. Then the fifth one is GDP at factor cost. Then GNP at factor cost. Then NDP at factor cost, and last one NNP at factor cost. And when we land up at the last component, that is NNP at factor cost, that is net national product at factor cost, that is the actual meaning of national income. So please understand the right flow of making all calculations, and if you can connect these 8 components, believe me, computing national income will be a cakewalk for you. But if you get confused in the terminology and you try to mechanically deal with these components, then it's a longer and complicated process for you. So if I guide you in a summarized manner what we have discussed by far, how do you compute GDP at market price? The first component, you take the gross value of all the output that you have produced, that is all goods and services that you have produced during a given period, minus the value of intermediate goods and services consumed. All production in the domestic territory minus the value of intermediate goods and services consumed, that will be GDP at market price. To that you add net factor income from abroad, you get GNP at market price. Then to GDP at market price, you subtract depreciation, you get NDP at market price. From NDP at market price, to that factor you add net factor income from abroad and you get NNP at market price. Now if you want to change the base from market price to factor cost, logically only one adjustment required. You take the indirect taxes collected by government from business entities minus the subsidies, so you arrive at net indirect taxes. Then what you do is GDP at market price minus net indirect taxes, that will give you GDP at factor cost. Once you get GDP at factor cost, now use your common sense, you want to arrive at GNP at factor cost. GDP at factor cost, GNP at factor cost. How would you travel from GDP at factor cost to GNP at factor cost? Base of both are factor cost. From GDP to GNP, there is one adjustment needed, that is net factor income from abroad. So GDP at factor cost, to that you add the net factor income from abroad, you get GNP at factor cost. Now suppose you want to arrive at NDP at factor cost, net domestic product at factor cost. For that you first take the base of GDP at factor cost minus depreciation. Task over. You get NDP at factor cost. Once you have got NDP at factor cost, to that you add net factor income from abroad, you get NNP at factor cost. NNP at factor cost, net national product at factor cost, that is the national income. So what happens when we are learning the concepts for the first time, it may appear to be little confusing, but once you get tuned to this and you start taking up lots of calculative examples in a flow, you will be just enjoying making the calculations if your concepts are clear. So let us do one thing. Let us write up all what we have discussed by far. And GDP at factor cost, its short form is GDP-FC, gross domestic product at factor cost, and it is computed by taking GDP at market price minus indirect taxes plus subsidies. And if you want to arrive at NDP at factor cost, you take the net domestic product at factor cost by getting NDP at market price minus indirect taxes plus subsidies. Do one thing, first write up this part of the note and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and write further. Net national product at factor cost, NNP at factor cost. The short form is NNP-FC. I repeat, NNP-FC, which is net national product at factor cost. And how do you determine that? You have learnt it, but most important thing that it is NNP at factor cost which is identified as national income. So how do you determine NNP at factor cost? You take NNP at market price minus indirect taxes plus subsidies. Alternatively, you take NNP at factor cost by taking factor income earned in domestic territory plus net FIFA. Now when you talk about factor income earned in domestic territory, let me tell you, this is basically income approach that we have written over here. How to get this thing, I have just written one line definition over here, but this is precisely the income approach, and income approach we are going to learn in the next class, not now. So as a matter of writing just one line definition, you write this. I repeat one thing, that I have not explained you this last definition. I have explained you up to this part. So please write up this much and then we take up a question. So first you write this quickly. Alright friends, once you have completed writing this much, let us take up a calculative example to get better understanding of this whole thing, and that will be question number 2 from your book. Let us read this question first. It says, consider the following information with respect to Indian economy in the past. They have given value of output in the domestic territory 20,000 crores, value of intermediate goods and services 8,000 crores, income of Indian citizens and companies earned abroad, income of foreign citizens and companies earned in India, then depreciation is informed, indirect taxes informed, and subsidies informed. Further given, determine the following, and we have to make 9 calculations. These 9 calculations are gross domestic product at market price, net factor income from abroad, gross national product at market price, net domestic product at market price, net national product at market price, then gross domestic product at factor cost, net domestic product at factor cost, gross national product at factor cost, net national product at factor cost. In other words, national income is to be determined in the 9th point. So if you can identify all components that we have learned by far, this question is asking you to determine each one of this. So let us see how to write up the solution over here. In your solution, you must mention that all figures in rupees crores. You get started with the value added approach, where you take the value of output in the domestic territory minus the value of intermediate goods and services consumed during the period, and what you get is value added, which is summation of value added actually, and we call this as GDP at market price, marked as A. Then you take income of Indian citizens and companies earned abroad, that was given as 3,000 crores, and from that you subtract the income of foreign citizens and companies earned in India, that is given as 2,000 crores. So net FIFA, that is net factor income from abroad, will be 3,000 minus 2,000, that is rupees 1,000 crores. And now to arrive at gross national product at market price, you simply take aggregate of A and B, that is 12,000 crores plus 1,000 crores, that will give you 13,000 crores. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much of the solution, let us move ahead and write up the later part of the solution. Still all figures will be in rupees crores. GDP at market price we have already computed. From that, if we subtract depreciation, we will be getting NDP at market price, that will be 10,000 crores. GNP at market price we have already computed earlier, and if we subtract depreciation from this, we will be getting NNP at market price. So you may identify that NNP at market price can be actually computed even by an alternate way, that is, you take NDP at market price, which we have got as 10,000, to that you add the net factor income from abroad, even that will give you net national product at market price. So look at this, you take it this way or this way, either way you get 11,000 crores. So please write up this part of the solution and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing the solution further. So still all figures in rupees crores. GDP at market price is 12,000 crores minus indirect taxes plus subsidies will give you GDP at factor cost. Once you get GDP at factor cost, you can even compute any other factor based on factor cost. So we have NDP at market price minus indirect taxes plus subsidies will give you NDP, that is net domestic product at factor cost. So please write up these calculations and then we move ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing the solution further. Now what we do is, we again get started from GDP at factor cost, which is 9,000 crores, and from that when we subtract depreciation, we will be getting the net domestic product at factor cost, and then we take gross national product at market price, we subtract indirect taxes, add subsidies, we get gross national product at factor cost. So please write up these all calculations and then I take you ahead. Alright friends, once you have completed writing this much calculation, let us move ahead and finalize the calculation. The last thing that we have to compute is net national product at factor cost, and we can follow two different approaches. One is you can take net domestic product at factor cost, to that you add net factor income from abroad and you get net national product at factor cost, which will be 8,000 crores. Or alternatively, you can take net national product at market price minus indirect taxes plus subsidies. It will also give you net national product at factor cost, and NNP at factor cost indicates national income. So please write up this whole thing, and that will be end of this solution as well as end of this session.